By the end of the 1920s, something was terribly wrong with the United States economy. There were signs that the 20s bubble was about to burst. Key United States industries weren't making a profit. Once thriving coal, oil, and steel industries were in trouble. Farmers began to struggle to survive. Falling prices made it hard to repay debts. Farmers lost their homes, and rural banks failed. The government enacted price supports to set crop prices high and help farmers make profits. Consumerism began to stall. Consumers ran out of disposable income and credit, so purchases slowed. And finally, rising debt. Both consumers and firms spent beyond their means and ran up unpayable debts. More importantly than these, the prosperity of the 1920s hid a vast inequality of income. During the 1920s, the rich got richer and the poor got poorer. Only a very small number of Americans actually prospered during the 20s boom. The wealthiest 1% saw their wealth grow by 75%, while most saw only a 7% increase. More than 70% of American families lived at the poverty line. Most couldn't afford basics. Many Americans didn't save money for the future in case they needed it, which forced them to use credit to buy the necessities to survive day to day.
In addition, Americans looked for quick riches in the stock market. The hot new trend of the 1920s was to invest your money in the New York Stock Exchange. Here's how stocks work. You have an investor who has cash on hand, and a company who has a certificate of stock, which is part ownership of the company itself. The company sells that stock to investors for their money. In turn, the company uses that investment money to hire workers and buy more machinery, with which they make more products. Those products are then sold for a profit. Because the investor gave its money over to the company, they are entitled to a share of those profits. Along comes investor number 2, who also has cash. They buy the valuable stock from investor number 1. The first investor sold his stock at a higher price than what he bought at, doubling his money, while the second investor is now entitled to a share of the company's profits. As wealthy Americans grew richer, they invested in the stock market looking for quick profits. They obsessed over the Dow Jones Industrial Average, which shows the market's health with a point system. It's kind of like the pulse of the stock market. During the 20s, deregulation of markets and pro-business policies had eased rules. Presidents Warren G. Harding and Calvin Coolidge had recklessly eased government regulation of the market, allowing for risky trading practices. One of those risky practices was speculation. Speculation was when investors bought stocks based on the hopes of a quick profit, not on the merits of the firm. It led to many investors buying bad stock and a lot of money being lost. The second risky practice was buying on margin. Investors bought stocks with only a small down payment and agreed to pay off the rest of the stock using credit. The problem with this method is, if the stock doesn't turn a profit, you now are indebted to a broker, with which you have no means to pay back the debt.
By 1929, the Dow had risen 300% from the previous decade. Only 3% of Americans were in stocks, but it seemed that anyone could get rich. In October of 1929, rumors spread that big investors were ready to sell their stock. Market confidence began to stumble, and investors hurriedly sold stock to avoid losses. On Thursday, October 24, 1929, panic investors dumped their stocks in mass numbers. As stock prices sank, wealthy bankers bought bad stocks to stabilize the market. The Dow stabilized going into the weekend.
But all of that was not enough to hold back the inevitable. When the traders returned to the exchange, the bottom fell out of the market. October 29, 1929 was the worst day of the stock market crash. It became known as Black Tuesday. Panic overtook investors as they dumped 16.4 million shares of stock, and stock prices sank. Small investors were left with huge debt, firms lost money, and many people lost all their savings. By November 1929, the market had lost $30 billion, and U.S. output was cut in half. The economy was officially shrinking.
Most Americans didn't have money in stocks, but they had money in banks. The uncertainty caused by the crash led to the panic to withdraw savings from banks. This all led to the banking panic of 1929. Millions rushed to banks to withdraw all savings at once. The bank rush drained funds, and many banks failed because they couldn't cover withdrawals. Over 600 banks failed by December of 1929, and millions of Americans lost their savings. Banks that had invested in stocks lost money and failed, evaporating private savings. Unlike today, the government didn't insure bank deposits, so money lost was lost forever.
The stage was set for the biggest economic catastrophe in American history. An economic disaster that had not been seen before and has not been seen since.